50. It's about stock market, right? Yeah, and the topic is also about stock market. So let us now jump into the point. So the basic point is, when you start a company, you can either have your own capital, which is your savings or something like that, or you can borrow it from some other person. So only capital or borrowings can be there in your company. Okay. So now when you have your own capital, it can take the form of equity or preference. What does equity or preference mean? Where does it differ? Equity people are the actual owners of the company because they have the voting decisions. With the amount they have raised or they have borrowed, whatever they are going to do, like invest in the plant or use it for day-to-day expenses, all that based with the voting powers. So which is actually with the equity shareholders. So they are called the true owners. With the preference shareholders is that they don't have any voting rights, but whenever you are going to pay equity shareholders some profit percentage or part of profit, before paying them you need to pay the preference shareholders. It's called equity shareholder. If you purchase the preferential, it's called preference shareholders, and based on the type of share they will be having the voting rights. So in the future, if the company is going to earn good profits, what will it do? It will distribute the profits as dividend. Here the word dividend is important because the profits which you are earning should will be paid as dividend to the shareholders, and it will be decided by the shareholders in the annual general meeting. Okay. So in our previous example, we have seen 1 lakh shares at 10 rupees, right? The 10 rupees is actually called as face value. In the 1990s IPOs, shares are used to be sold to public at 10 rupees. It might be 5 rupees, 2 rupees also there used to be shares, but it was at face value. In our example, see, the 10 rupees, as I said to you, right? It's a face value. And now take the example, company earned 1 crore profit, okay, and wanted to distribute 50 lakh to owners as dividend, and 50 lakh to be used for building some new factory, because they need to see the growth of the company also, right? They can't pay completely to as dividend to the shareholders. So you are distributing 50 lakh to shareholders, it means everyone who purchased a share at 10 rupees will be getting how much amount? You can say 50 lakh is the total profit which you are going to share for 1 lakh number of shares, which means 50 rupees per share will be getting. The shareholder will be getting, each share will be getting 50 rupees. That is only called as earnings per share. You will frequently hear this word EPS in the stock market. So just this is the meaning, which earning per share means the amount which the shareholder is getting per share is 50 rupees, right? So what does it mean? How the companies say that one? The face value is 10 rupees for which you are getting paid 50 rupees, right? So 50 by 10, it means 500% is a dividend they are declaring to the shareholders. So whenever a company declares a dividend, it will be declared as a percentage of face value only. This is a critical point which we need to remember. So through this explanation, you can easily understand that whenever a company is going to earn profits and is expected to grow in the future, shareholders will get huge profits from the company in return as dividend, right? In our example, 500%. If the company performs even much better in the next year, it may get into 1000% or something like that, even more than that one, right? So it's simple that whenever a company earns more profits and grows, the dividend percentage, I'm talking about the scenario of 1996 initial days, how it used to happen. So whenever a company is about to have decent profits, the shareholder will get a decent return in the form of dividend. So by saying this is an opportunity for money making in growing sectors like automobiles, FDI was allowed in 1994. So by seeing all this stuff, people started buying shares from existing shareholders. Like in our example, we have 10 rupees face value, right? The 10 rupees ka share value people used to buy at 20 rupees, 25 rupees. It may be based on your expectations, like how the company is about to perform in the future and what is the dividend they will be giving in the future. Based on the expectation and the growth about the company, they used to buy it at much more than face value. The excess price which they used to pay more than the face value is called as premium. When you say, suppose if you buy the share at 20 rupees, the face value 10 rupees, then it would be termed as you bought the share at a premium of 10 rupees. So that's how the word premium came into existence. And from there, many shares were used to be trading at premium only. Suppose I'll show you an example. See, this is the example of Maruti Suzuki. The government divested 25% stake in Maruti Suzuki at 120 rupees per share. Its face value is only 5 rupees, but the government sold it at 125 rupees, which it already hold. Because by the early 2000s, everything was trading at the premium only. No one was trading at a face value or something like that. Because whenever I said you right, whenever you expect a growth in the profits of the company, people used to buy it more. So that's what is happening in every sector and every share. See, people thought it has a scope of becoming market leader in automobile segment during 2003. The listing price was 125. Listing, I mean, it's a divestment rate was 120, but people bought it for 160. Even it went for 160 on listing date. So by mid 20th century, what happened was that every person was buying share, expecting the company will perform better and the share price will increase. Like during the 1990s, which I explained you, many people used to buy shares to earn dividend, which is a good source of income. But now the dividend is being replaced by market price. Suppose I'll show you an example. This is example of Feature Motors. It paid a dividend of 110 rupees per share. Face value is 10 rupees, which means it paid 1100% in dividend. But the point is the share value is 20,000. Yeah, 20,000 rupees. So what does this 1100 come to at 110 rupees? When you divide by 20,000, the interest is 0.5% per annum. So now do you think people are buying it for dividend nowadays? Is that your answer? No, it's obviously no. Now people are buying just because they expect the company to grow, they are buying. But unlike in 1990s where dividend was the main source of income. So now you have a clarity that people are buying shares because they expect the company to grow further and make much more profits, right? Yeah. Yeah, this is a proverb. One person buys a share expecting some other person will buy it at a higher price. And this is what is happening in the market now. No more earning source, no more dividend. When you buy a share, you expect that it will increase and you some other person will buy it at a higher price. And that's called market sentiment. What if it doesn't happen in fact or in the market? Market falls like 1995 Harshad Mehta scam happened, right? At that point of time, the market sentiment, the people didn't expect that companies will grow in the future again, and they sold everything, and the market was in crisis. In the same happened with 2008 crisis also. So that's what market sentiment means. People will buy, expecting there will be growth of the company, and some other person will buy it at a higher price. See, here is an example of monkeys doing trading, like how it happens and all that. So there's a funny story. I'll just share the link in the video. You can watch it there. For time being, let's move on to our top. So now you have a clarity regarding what is driving the share price and how it is being affected. Okay, now how to buy shares first of all. Previously, shares used to be in this physical form, like you can see here, Reliance Industry Limited. You are having a shares. There will be share certificate issued in your name. That how many shares are you holding, and what is the value of that share. All that will be given as a physical certificate. But now the government made it mandatory to hold them in demat account. So like this Sharekhan, Upstock, Zerodha, we are having so many brokers who provide two types of accounts for you once you approach them. The demat account and another one is called trading account. So what does a demat account mean and trading account mean? Demat account actually holds shares for you, and trading account is used to trade the shares. Okay, fine. Then what's the difference between both of them? To understand this, we need to have a technical idea about how stock market works. So whenever you are going to buy something in share market, it takes t plus 2 days to get it delivered. Suppose if you buy it on Monday, your account will be credited with the amount of shares only on Thursday morning. It means t plus 2 days, right? You understood? If you buy it on Monday, transaction days t is equal to Monday plus 2 days, Tuesday, Wednesday. That means on Thursday, by Thursday, you will get the credit of the shares. But you know, in stock market, there is no need to take delivery also if you want to do intraday. There's something called intraday in market. What does it mean? It means you can buy today and sell at afternoon, evening, or you can sell in the morning, buy it back at the afternoon. You know, you can even sell it at the morning when you actually don't even have anything. You can sell it. So without having shares, when you sell something, when you sell that shares, it's called short selling. It's allowed in our markets also. Or else you can do something like buy today, sell tomorrow. You need not take the delivery because delivery will happen on t plus 2 days. Buy today, sell tomorrow. All sell today, buy tomorrow. So these type of traders are called as called as intraday traders, because they mostly do intraday. They will buy it and sell it on the same day, so they need not have the delivery into this account, right? That's why they don't need demat. They can just have the trading account and close the stuff. But the point is, whenever you open an account, generally your demat and trading account will be opened on a collective basis. So once you approach a broker, they will directly open both. Let's say you can move there and check for this Reliance stock. There's something called as traded quantity. 65 lakhs, only 22 lakhs were taken delivery. It means 34% are on delivery basis and 66% are on intraday basis. And the logic is that only 20% of the turnover will be on delivery basis. It means 80% are intraday traders who just speculate the market, what is going to happen and whether to buy or sell. That's it. So this is what will happen in the market. You find very less people who know about the company and what is going to happen, who hold the stocks actually in the demat account. Many people just do trade on the stock. So from the above discussion, we can say that there are two types of persons. One is investor, one another person is a trader. So now, how do you differentiate them? I'll just say it with an example. Suppose today you get a news that Sun Pharma will be acquiring Ranbaxy. So the first type of persons are investors. What they will do is they will check the financial position of the Ranbaxy, like why are they acquiring, what will be the benefit they will get from the company in the future. And there is something called a discounted cash flow method, which says generally people use that one, which says what is the benefit you will get from the acquiring the company, what is the increase in your cash flows, or what is the increase in your position will you get. So based on all that criteria and understanding the financial aspect and fundamentals of the business, they'll decide whether it's a buy or sell. And this is analysis is known as fundamental analysis, because you are going into financial statements of the company and estimating how it will work in the future and all that stuff, right? So that is known as fundamental analysis. And the second part is the traders. What they'll do is once we get this news, they'll just go and check the graphs. I'll discuss about the graph in a minute or so. Okay, so they move on to graphs and decide the time frame. Like some people expect that this news will have an impact on only today, so they will do intraday. It means buy and sell today only. It will be closed today only. Some people will do swing trading if they believe that the news will have impact over 5 days. Like today it will increase, tomorrow also increase, day after tomorrow also it will be increasing because of the news. Then they will use the swing trading, which, and also there is something called as positionals, which runs in months. Generally people don't do traders don't do positionals. Mostly they will stick on to swing or intradays, and they will decide whether to buy or sell the stocks. And this is known as technical analysis, because they are no way concerned about the fundamentals or what is happening with the company. If you are expecting that Eicher Motors or Maruti Suzuki will be leading the automobile segment during 2000s, you would have bought the share at 35-24 rupees only, right? See the value addition now. It even went to 31,000 high, which means the one share 20 rupees you bought in 2000, it's worth 30,000 by in 10 years, sorry, 20 years. Maruti Suzuki also 337, it's somewhere around 150 rupees in 2000s, which went to 8,000, 9,000. So what do you think? Investors make decent amount of money, but what about the traders? They will just enter here and exit here 1 day, 2 day, that's it, max, like a max of month. Yeah, I was talking about the price movement, right? Yeah, see, there are different kind of chart, like line charts, which just shows the what is the closing rate of the start stock, and the candlesticks charts, bar charts, point and figure whether it crossed the previous high or not. We can make it through this one. Like that, there are many kind of charts. Many people use candlesticks charts. So before going into that one, I'll just explain you what will happen in the market. So this is my trading account with up stocks. You can see shares will be here. Whatever the shares here, the bid means that whoever want to buy will place their orders, and you can see it over here. This is the ask, which means the sells. Whenever someone wants to sell something, order will be here. Whenever the rate matches with this one, with the rate, if the best bidder and the best asker, I'll show you in I'll post a video of live market after some time, through which you can understand how it works. So basically it's like the bidding will be the buyers and the ask will be the sellers. So what happens every day morning at 9 o'clock, between 9 8 is that all orders will be taken from the individual investors, but none will get executed. From 9 8 to 9:15, the exchange will work out at like what is the rate or what are the bids they have, what is the rate at which maximum bids can be executed. I mean to say, I said there should be matching between the top bid and the ask, right? So they will find out the rate at which it's maximum, and they will start the trading at that point. And then market opens at 9:15 a.m. and closes at 3:30. Every share has open. I said 9:15 high, low. High is the rate which it went in that day, and low is the rate which it went at that one in that day. Close is the rate which it closed at 3:30. But our indexes NSE and BSE will take the average of 3 to 3:30 and post it at 6:30 p.m. I'll explain you about candlesticks. So see, suppose the share went it opened at 100 rupees, went till 120, is the high 120, and the low was 90. It closed at 110. So if you see, effectively by 3:30 open, I mean to say close is more than open, that is 110 is more than 100, then we will see a green candle there. In the same way, if the 110 is the open and 90 is the close, you will see a red candle there, because the share closed at more less than open, right? It's a decrease, so it will be shown in a, I'll show you in a live example here. See, you can see the candles right here. It can take a frame of 1 minute, you can use it 1 minute or 1 hour. Currently, because the exchange is off, you're not getting the data, but normally you can use that one. So basically that is a basic point, key whenever there is a open price is more than the close, there will be a red candle. When close is more than open, there will be a green candle indicating that there was a increase in share price or decrease in share price. Okay, fine. Now everything is fine. You understood how share market work, how charting work, who are investors, who are traders, and all this stuff. Now just let me ask you a question. Okay, I understood that share prices increase or decrease based on a buy and sell. How does this Nifty value fluctuate? I mean to say share price, they are buyers and sellers. What is it Nifty 50 and how does it how is this value determined? So Nifty 50 means it contains 50 shares. That 10,950 is an indicator of 50 shares. Doesn't mean 50 shares are only there in exchange. There are more than 1700 companies listed on it. And BSE 30 means it tracks 30 shares. And also really listed 1300, 3500. This is the fact sheet of Nifty. HDFC Bank holds 10% weightage. Reliance 9. How HDFC only corporation 7.31. All these 10 stocks put together gives 62% weightage. So you can see majority is for financial sector, because if the finance and energy grows, there will be good growth in the economy. So even if there is no movement in the remaining 40 stocks, if this 10 stocks which contains 62% weightage moves, it gives a good movement to the Nifty, and you can see some 100 or 200 easily, and even 400 500 points change in the Nifty. And I was talking to you about all the stocks, right? It contains only 50 bulk. See, Nifty 50, these are the top gainers. These are the top losers. You will get all the stuff. You can move on to live market and then equity stock. This is the Nifty 50 stocks. Nifty tracks all this stuff. And on a consolidated basis, the result was minus 125. I'll show you how it's computed in no time. And then there's Nifty Next 50 mid cap. I said 1700 stocks are there. So all these are segregated on this on them. So I said that the computation, there's a weightage for Nifty. So now let us understand it with the HDFC example. In that sheet, if you see, HDFC was given a percentage of 10.31 weightage. So what does it mean? If HDFC Bank increases by 1%, 1% into 10.31% is the weightage which was given for Nifty. So currently Nifty value is 11,000 into 10.31% is the weightage of HDFC, and the change of the stock is plus 1%, which means the total value comes out to be 12 points. There will be Nifty will increase by 12 points if you see on individual basis, and all other stock 50 shares will be increasing or decreasing based on the momentum. And based on the percentage of weightage, everything will be added to the value, and the result will be this number. On a consolidated basis, this is what you get. That means that out of the 50 stocks, some may increase, some may decrease. But being in red doesn't mean that everything has decreased. Something has increased, something might not have increased. But based on the weightage and the impact which they have, some stocks have decreased very significantly. You can have a conclusion. And during 1996, NSE started with the points of 1000. Now it's 11,000. So you can see the increase of the percentage return which Nifty 50, if you have invested in just Nifty 50 stocks, the return which you have generated from that one. Here's something called as market cap. Whenever there's a loss in the market, people, our news channel says that 2 lakh crore market cap has been evaporated from the market, or 1 lakh crore have been added to the market. What does it mean, market cap? Market cap is very simple to calculate. Shares of, suppose you're calculating for Reliance, what are the Reliance shares in the market into what is the current price, you will get a market cap. Suppose 1000 shares into 10 rupees. 10,000 is the market capitalization, which actually runs in crores. And one more point which we need to understand in the calculating market cap is that normally they will use only free shares There's something called as free float mechanism and full float mechanism. Free float mechanism is a says that only shares which are freely tradable or available for trade in the public, which actually can be traded. There is some other shares called locked for trade. Suppose if there's a condition for promoters which is guided by SEBI that they can't sell it for 3 years or some kind of regulations, and for some FIAs also, like foreign institutional investors or some government holdings which actually can't be traded or they are locked in for some time, they are not included in the free float mechanism. Only the shares which are freely being traded in the market will be included in that one. So generally for comparing and all that stuff, NSE and BSE uses free float mechanism, and the market cap will be based on a free shares available to the public into price. Let us move on to our next topic. See, suppose if you want to buy 500 shares of Reliance, you had done a thorough analysis, technical and fundamental, and you were sure that something going to happen, which will bring the Reliance share to a 52-week, but you don't have amount of 6,40,000. So what can you do? Then here comes a rescue in the form of derivative. So here comes the derivatives. So but the point in derivatives is that whatever you're going to buy today, it will expire on the last Thursday of the month, and the derivatives are of two types: options, futures. And in options there are two types: call or put. See, this is a derivative structure for Reliance. Today it's 1277. There is a future contract which you click, you will get that one. Now we are focusing on equity derivatives, and that too on options. So these are the various strike prices: bid, ask. I said, bid and ask, there will be there. Bidders are the buyers, ask is the sellers. Okay, fine. Now the current rate is 1278. Okay, first of all, I'll directly go to, so it's in between 1260 and 1278. Okay. I'm sure that it goes up. So what I will do, I can buy 1300 call. What is the premium? 24.45. Or if you're sure it will go down, you can buy any strike price here. I want to go to 1200, 8.45. So that one option is like a contract. So today your Reliance was at 1277. If I feel it will go up, I will buy a call. Okay, by paying some premium, I have shown you that 24.25 is the amount of premium. It's like an advance amount which you are paying for entering into contract. So 24.45 into 500, 12,200 you need to pay if you want to go for a call. Or if you want to go for a put at 1200, you need to pay 8.45 into 500, that's 4,000. Now let us take the example 1300 call. If you bought 1300 call, and also I have said you that the option expires on the last Thursday of every month. In February 28th is the last Thursday, so it will expire. What does it mean? You bought a 1300 call. Why did you buy it? Expecting that it will increase, the share will increase more than 1300. You will get some profit. You didn't have this 6,30,000 or something amount like that. So your expectation will go correct only if the share exceeds 1300, right? You bought a call, expectation is increased, and it should exceed 1300, then you will get into profit. So take the example of 1320. You bought 1300 ka call and the share was 1320. It exceeded your expectation by 20 rupees, and your expectation, you are in a right way, expecting it will increase, so you will get a 20 rupees. 1340, you will get 40 rupees. 1400, you will get 1400 rupees, because whatever is above your expectation, I mean the strike rate, you will get that. And to get your profit or loss, you need to deduct your premium. In our example, it was 24.45. So 20 minus 24.45, you'll lose 4.45. 40 minus 24.45, so 16 rupees somewhere around. 100 minus 24.45, 64 rupees somewhere around. Sorry, 74 rupees somewhere around. So you'll get the profit or loss. Now what was the scenario if you had bought a call and the price closed less than 1300? Expired. What was your expectation? More than 1300. It didn't move. Suppose 1290 or 1280. It didn't move more than what you expected. So your option expires at 0. And your loss will be the premium on which you paid. Now take the example of put. We bought a put at 1200, expecting the price to go less than 1200. Okay. On 22 price level really less than 1200, your expectation is in line with the market. So what will happen? 1180 is the amount on the expiry date. So whatever will be less than 1200, you will get the profit from that one. So 1180, how much is it less than 1200? 20 rupees. 1120, how much is less than 1280 rupees? 1150, 50 rupees. So you will make a profit of this one, and you need to deduct the premium for that. Premium is just for as an advance for this contract. So you need to deduct it to get the profit or loss. See, you can buy 1280, 1300, 1320, 1340. Once you move away from the nearest range, I mean to say currently the stock is trading at 1280, right? 1277. The nearest amount, because the chance of moving here will be high. Even if it moves 10 rupees, you end up getting some huge amount. So you need to pay some huge premiums when you take. This is called at the money calls, which is near to the current rate. There are problem with the future stocks is that whatever you're going to buy, it will have a minimum market lot. See, the minimum market lot for Reliance is 500. It means you can buy only in the multiples of 500, either 500, 1000, 2000, whatever it might be, but it has to be in the multiples of. Yeah, and I was saying about bid and sell, right? These are the bids. Someone is asking for 41, someone asking for 43, someone asking for 43.95. But the sellers are at 47.45, 47.56, 8595. This will be executed only when either seller decreases or buyer increases, and the price should match. Today see 43.5, high was 57.55, low 42, 44. So yeah, typically this is how option market works. Just go through the example, you will have a clear clarity like and about what is happening in the market. See, this is the chart for Bajaj Auto. As you can see, these are the candles. See, from the past 5 days, the stock is on a high, 6 days, it's on a high range. And now here something doji formed. See, and stock was in complete high uptrend. But here the doji, what does the doji mean is that it went up, it went down, but finally it closed at the rate where it opened. It means that there are sellers and buyers. There is an indecision in the market. There are people buying and people selling, and no one knows what is going to happen. And as per my experience, within the next week you can see it fall till 2789, I think, and there may be a consolidation, and then it moves up and down. And the stock market is all about up and down. You just need to have that make money and get out. You shouldn't be greedy. That here, even if I go into a short position, I'll place a stop loss over here because it shouldn't cross here, because previously at that point of time there was a huge selling occurred and it went down till here. So yeah, let's see what is going to happen tomorrow, and in our next video I'll be discussing about option strategies and also futures and how you can use both of them to make money. Or else, yeah, but I'm saying from a learning perspective, if you're interested you can do that one, or else no problem. But everyone should understand everything, and everyone should have a fair education. That's what I feel, and thank you.